Hey, what's going on, guys? Welcome back to the channel. My name is Jackson, and in this video, I want to talk to you guys about how to diversify your portfolio. Once again, this is not financial advice. Please do your own research before making any investment opportunities. I did want to make a video talking to you guys about how I have diversified myself and how I can prepare for really any market conditions. Starting off with the first category on our list, and these are safe ETF and dividend stocks. These are companies like XLE and ExxonMobil, BP, consumer staples. So you can think Walmart. These are companies that really aren't going to be changing a whole lot when the economy goes awry, or if the economy starts doing well. They're going to be very safe and non-volatile assets. This is extremely important, like I mentioned, for if the economy does take a turn for the worse or the market takes a turn for the worse, a lot of those high growth tech companies may not do as well. And it's important to keep in mind that these companies, you may not see a lot of appreciation from them, but what you will see is a safe, consistent dividend. Doing this over 20, 30 years is a great way to build up some income. Investment class number 2 is crypto. And I'm not specifically targeting Bitcoin, I'm targeting different asset classes in the crypto space. We've seen Bitcoin with a massive runoff with all of the money printing that we've seen in Q3, 4, and now Q1 of 2020. And this is just really going to be a hedge against inflation if we do see it. I think crypto is not going to go anywhere. We're going to see Ethereum start to take off and start doing better things as more technology is available to use it. And I think getting ahead of the curve and having even just a small percentage you're not going to lose sleep over into this asset class. It can be anywhere between 5 to 15% of your portfolio. I would not go higher than that. And even if you wanted to go only like 3 or 4%, that could work too. But just having a little bit of exposure to this, and there's even ETFs you could buy, so you can do some trading in your brokerage of choice. Moving on to asset class number 3, we have SPY. And SPY has been a very big performer in the last 10 years. It's done tremendous. And if, like I mentioned, if you were holding those dividend stocks like XLE and ExxonMobil and BP 10 years ago, you haven't really seen a lot of growth because those have just been consistently paying their dividends and they haven't really done a whole lot. They've stayed flat. But the S&P has done considerably well in that amount of time. It is more tech focused, so you need to be prepared for that if we do see another kind of tech recession, then those may not be stocks that perform very well, but this is the point of diversification, is so that you can have assets that do well, assets that do not as well, and overall you just hope that everything as a whole goes up just a little bit. Asset class number 4 is growth ETFs, and specifically I was targeting more of the green energy space. So things like ICLN, which is a iShares green energy ETF, and LIT, which is a EV ETF specifically for batteries. And I think this industry is just going to do really well in the next 5 years. This could be the new tech explosion that we've been talking about. Sure, these are going to be a little bit riskier. There's going to be some more validity in these, but overall, I think these are going to be really well. They don't pay any dividends, so that's why you're protected with dividends by some of the other stocks we mentioned in this. And I would put somewhere between 15% of your portfolio into this, just because it's nice to have a little bit of exposure. A lot of these things may not be encompassed in the SPY, but overall, you would expect these to do really well in the market conditions that we have with companies like Tesla, NIO, and XPeng that are continuing to deliver products. And as we see the EV space continue and the green energy space to continue under the Biden administration. And going with number 10 is metals. And this kind of goes hand in hand with the dividend and safer stocks we talked about. Metals are not going to pay a dividend. These are things like gold, silver, platinum, copper. We've seen a huge run up in copper in these last 3 months or so. And I think these are a nice long-term play just to have these in your account in case everything goes wrong. Just have some sort of hedge against the US dollar, I think, is going to be a vitally important strategy moving forward into the next few decades. You're not going to get any dividend payments on these, but what you can get is hopefully some appreciation. We've been in a pretty bear market when it comes to gold and silver. So maybe in the next few years, we will be seeing that kind of momentum shift back to these silvers. And moving on to the next one, we have emerging markets, specifically WVO or VWO is Vanguard's ETF that is really good. They have a very low expense ratio, And emerging markets are companies that is not the U.S. stock exchange. So you can still invest in a U.S. indice, but it's going to track assets that are not in the United States. So things like Alibaba and other smaller companies that may not be in the United States is going to be a great play, because I think we may have seen the long-term high of the U.S. stock market. Maybe for the next few months it's going to continue going up, but after that, I think we're going to see a pretty flat lining of the U.S. Stock market. And so diversifying your assets into other places beyond the U.S. is really important. And I would put anywhere between like 10 to 15% of my portfolio into this asset class, just because you want to still have some exposure, but you don't want to be over leveraged in case something does go down, because emerging markets in the past 10 years have really not done that great. They've actually done very bad. If you were to have put $10,000 into the emerging markets about 10 years ago, you really would only probably have about 15,000, which sounds like a lot, but when you consider that the SPY has just almost over tripled in value since that time, it puts it into context that this may not be the right play, but again, it should be a little bit safer. And finally, for the last market trend is going to be 15%, and this is really anything you want. Leaving this 15% gives you the opportunity to then not only have fun with investing, but to find opportunities that you think are going to be good. I always reserve this 15% for swing trading and companies that I think are going to do well, maybe some options, some daily options that I'm interested in doing. The rest of my portfolio is just to buy and hold, and just hold it forever. But I really think that the market trend and be able to analyze what you think is going to do well in the future is going to be important. And so it's always good to have an interest in investing and being able to take your market trend and investing it in companies that you believe in that may not be accounted for in the asset classes that I've talked about. So with that being said, guys, thank you so much for watching. My name's Jackson, and please like this video and leave a comment down below saying, where do you have most of your money stored? Are you invested in these high growth companies like Tesla and NEO, or are you playing it more safe and switching to AT&T and ExxonMobil? Please let me know down in the description of this video. Thank you so much for watching. My name's Jackson Walsh, and I will see you guys next time.